Watch today's video carefully. You'll definitely learn something new. But don't just watch. Apply it on live charts. Practice is the only way to remember and improve. Imagine you bought 10 shares or entered an options trade. Check if the pattern gave profit or loss. If it's a loss, find the reason. If it's a profit, note why. This way you'll learn risk-free. So let's begin with our first candlestick pattern. Now, what do we see here? Look closely. There's a candlestick. Here the body is very small while the shadow, or wick, is at least 3 times larger than the body. Here it looks like a small stick with a little bump on top. This itself is a pattern. Now, what pattern is this? The name is written below. It's called a hammer. I'm keeping it simple for you. When you look at a chart, you'll see candles moving upward or downward. What you must focus on is the trend. I hope by now you're getting the point. That's the basic idea. What's important for you is to connect candlestick patterns with these trends, because these patterns often signal when a trend might be about to reverse. Now, what does reversal mean? Simply that the current trend is about to change. For example, suppose the market has been falling, and now it's ready to reverse upward. You'll usually see a candlestick pattern that shows this. One such pattern is the hammer. And remember this rule, all bullish candlestick patterns should form when the market is moving downward. I'll show you some bullish candlestick patterns now. You'll see them at the lower side of the chart. The trend might reverse. These are the bullish candlestick patterns we'll be studying. Always remember, they should appear near the bottom. Here's how you should think about it. If the market is in a downtrend and a pattern forms at the bottom, that's bullish. But if the market is in an uptrend and a pattern forms at the top, that's bearish. That's really all you need to know for now. Now let's move forward and see how this works on an actual chart. Suppose the market is in a downtrend and suddenly a hammer forms. Now, how do you confirm that the trend is actually reversing? Watch the next candle. If the candle after the hammer closes above the hammer's high, that's your confirmation. Only then you enter the trade. And your stop loss? You must place it just below the hammer. Never forget to set a stop loss. It's crucial. It's what protects you. Of course, candlestick patterns won't always work 100%, but if out of 10 trades, 8 or 9 works out, you'll still be profitable. The key is discipline. If your stop loss is at 1, then you manage risk accordingly. I will explain in upcoming videos about the risk-reward ratio, so follow that. I gave you the hanging man as an example. You've already seen how a hammer forms. Now notice how it flips and becomes a hanging man here. This one turned green, but like I said earlier, the color doesn't matter much. After that, you can clearly see the market change its direction. It started moving down. That's why you need to look at such examples thousands of times to truly understand.
Now let's talk about 2 more patterns, the inverted hammer and the shooting star. We've studied the hammer. It looks like a hammer. Flip it upside down, and that's an inverted hammer. Where does it appear on the chart, at the top or bottom? It appears at the bottom. Why? Because the inverted hammer is a bullish pattern, and bullish patterns form at the bottom. Spotting it there signals a potential upward reversal. But if the same shape forms at the top, it's called a shooting star, signaling a downward reversal. So, shooting star forms at the top. These look similar to hammer and hanging man, which confuses many traders. Then boom, the trend changes, like in this example where the price shot up. With practice, you'll spot hammers, inverted hammers, shooting stars, and hanging men daily. These are just 4, more to come, but observe carefully to recognize them. Where is the entry point for good profit? Entry is at the close of that confirming candle. Stop loss? The high of the shooting star. Clear? Great. Let's move on. Next is a common single candlestick. Name is Doji. Many know the name but not its meaning. Candlesticks tell the buyer-seller story. A doji shows neither side wins. It looks like a plus sign. Price hits high and low but closes at the open. It's a tie after maximum effort from both. So, a doji means an equal battle. That's the standard doji. Types vary by appearance, like the Dragonfly Doji. Long lower shadow, small body on top, like a dragonfly. Even if black or tiny body, it's 1. Example, stock opens. Sellers push down to a low, but buyers push back up. Buyers dominated despite sellers' effort. So Dragonfly now is Gravestone Doji. Long upper shadow, small body at bottom, like a gravestone. It's bearish. On chart, a red Dragonfly Doji forms. Color doesn't matter, it's bullish. Sellers push down, buyers up, and price rose. Another example, cross-shaped Dragonfly at bottom. Market falls, then booms up. Doji signal reversals. For Dragonfly at bottom, confirm. Next candle closes above Doji's high for entry. Stop loss below Doji's low. Gravestone example, upward trend, gravestone at top, boom, price reverses down. This is theoretical. Real trading involves psychology. Practice on charts, paper trade, build skills step by step.